Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
See, as usual, I was trying to time that right, but I got it wrong again. But welcome to Property Investing Insights. This is your fortnightly installment. This is where we do the podcast away from Phil. So we actually get some good substance out today. Thank you for all of your messages with regards to the bereavement we've had at RPG. They are very well received and very well appreciated. After a little bit of a hiatus, yes, we've started the podcast again. And today I thought that I'd bring in a very special guest. He's no stranger to RPG. For those that have been following us for a little while, you would see this familiar face. But I thought I'd bring in the introduction from my perspective, and then I will get my guest Ross Le Quesne to then also give a brief about what he's been doing all this while. But Ross Le Quesne, from when I initially was introduced to him back in the 2011-12 era, was one of the gun brokers in the Aussie franchise and was one of the highest grossing brokers in Australasia. And apart from that, he was also a really prolific investor. And then he's then had his life journey, and that's what we're going to talk about. And like every podcast, there is not a lot of preparation here because we want to keep it organic and keep it flowing from not a textbook approach, but real life experience, so that we can then give you that knowledge that we have, both Ross and I have accumulated over the decade and a half of investing and working together and mentoring each other over the years, to show you how a portfolio does morph if you give it enough focus and enough time. So Ross, welcome.
Thank you.
Yeah, I've been trying for a while to get you on this podcast, but with that visit at my place the other day, you finally succumbed.
Oh, definitely. It must have been all those treats that Reshmi served me up with, buttered me up, and here I am.
That's right. Yeah, you're a glutton for sweets, right? That's good. So before we start on the portfolio journey, obviously you've had a life journey professionally. Did you want to talk about that briefly, so that our clients get a feel for where the expertise lies and the advice is coming from?
Yeah, for sure. So, it's been close to 25 years in the mortgage industry now. We started in the sort of credit area straight out of school in the back offices, and then went to owning my own Wizard home loans franchise.
The Wizard days.
Yeah, the Wizard days. Yep. Back with Mark Burris. And then in 2009 we were acquired by Aussie Home Loans then, and we transitioned into Aussie Home Loans. We had the office there in Parramatta, and as you mentioned, from 2003 when we started the franchise, and around 2011, 2012, we were the number one Aussie Home Loans franchise nationally, and for the best part of about 5 years, we were the number one office, and personally I was in the top 20 brokers within the country. And through that time I gained a lot of experience, and was introduced to great people like yourself along the way, and grew my knowledge in property investment, started investing myself, helped a lot of other clients and our mutual clients also into one of the toughest areas, which is actually financing investment properties. So I got to see the inside and the outs of a lot of people's worlds in terms of how they go about building their property portfolios, alongside sharing what I was learning on the journey as well, in terms of investing myself to be able to create and help people along with their property investing journeys. So that led us to obviously building a really strong loan portfolio within the business, And, around sort of 2017, I was, looking at options and decided that, hey, I'm still young. There's still time for me to do some other things. So, in the next couple of years, I wound up the Aussie business and sold those businesses, traveled the world for 6 months, and then launched into a mortgage broking coaching business where I'm coaching mortgage brokers and giving back. So, yes, I still teach them how to be a good property investment mortgage broker is one of the topics that we discover, and, kept my passion around property investing, and here we are today.
Absolutely, and it is acknowledgement time. So you were introduced to us by a client, Mariana Patchett, and you then in turn introduced us to Phil. I mean, I'm still scarred by that. So it goes to show that like-minded people tend to be they tend to attract each other, right? And it is a journey that we went in terms of the portfolio. And what I wanted to do today was explore both what you thought you could. With the benefit of hindsight, what you would have done better, and then the aha moments as time goes by, and of course things that you're really grateful for in terms of within the portfolio, how it has changed and morphed your life, and highlighting how when everyone today is investing in the flash in the pan, where time and structured approach in investing is the way to go.
Oh, definitely. Yeah. I couldn't agree more. It's been interesting personally watching my brothers go through a development. They did a 4 townhouse development through COVID with all the challenges, and I kind of look in I bought a couple of just buy and hold. I'm like, for all the pain that they went through to do that, and a simple buy and hold strategy in terms of the returns that you've got compared to the blood, sweat and tears in an active development, and you look at the numbers at the end of the day, and they're not a lot of difference, but in terms of energy, and it's been a massive difference, right? So, and I know in the Right on Track meetings that I used to attend with you guys, you would often talk about that, and there's something to be said for a boring buy and hold strategy.
Yep. You got to keep it simple, right? Keep it simple and let time do its magic, provided the selection of the properties is good and in line with what you're trying to achieve, right?
Oh, exactly right. Yeah. Exactly right.
Yeah. And you can make it exciting by doing some really safe developments. Most people end up, biting off more than they can chew, or they bring in the development way ahead in the portfolio when really you should be just putting the foundational properties in play.
Oh, definitely. The whole, going into your property investment journey with a strategy and understanding that is key. And I think it's, why we work together for so well, and, along with, other guys like Munzerl and so forth, because we understood that, hey, it's not just a short-term thing, right? That the move that we make today is going to affect that second and third and fourth property.
Yep.
We were talking prior to coming onto the podcast, and we were chatting about a market like Perth, and, buying that wrong property the first time you purchase can really set you back, because as we know, it's, the springboard effect. You buy one property, that leads to 2 to 4 to 8, etc. Right? But if you get the springboard wrong on number one, then you're stuck at number one, and you can't go to number 2 or number 3. And understanding that, and understanding the different market cycles and how they move, and that's something that again, if I use that Perth as an example, you and Steve researched that area for many years before jumping in, and every Right on Track, I think Steve would do around the grounds and sort of talk about and saying, hey, whilst it was at the bottom of the market, it was not the
not
time
the time to jump in.
It was
Yeah.
not the time to invest, right? And a lot of people don't understand that. They'll think, oh, it's at the bottom of the market. It's on sale. I want to get into that property right now because I want to try to pick the bottom.
Yep.
But what do we know about trying to pick the bottom?
You don't know how long it's going to languish at the bottom. And so we really need to see green shoots before you jump into that bottomed out market, right? And at the same time, we also need to be looking at as if the market peaks or is looking at peaking. You really need to look at it from, okay, maybe I need to change the strategy in that area or the type of property, or wait it out because then you're at the top of the cycle and it needs to go through this whole cycle to get you the next phase of growth.
Yeah, and we're talking about seeing what mistakes people make, and I think that is probably one of the, if I generalize and I look at the difference between a sophisticated investor and your mum and dad investor, wait till it's too late.
Yep.
Right? They'll be at the barbecue talking about that, so and so, they bought this property and hey, it's doubled in value over the last 3 years. Oh, maybe we should get into the property.
Yeah.
Buy in at the top of the cycle.
And trying to emulate what they've done, right?
Yeah, try to emulate what they've done. But, and probably that leads to another sort of point, and probably a point, you mentioned, what would I have done differently?
Yeah.
And, one of the things that I probably would have done differently is start my investing earlier. I quite often think about, well, hey, had I not started, I think I bought my first property in 2011. So, at that point in time, yes, I'd had my owner occupied and a couple of other things. I had the business and a number of other things going. But, had I started, when I was 25, in the year sort of 2000, what would have been the difference? Right. And you realise that, again, 13, 14 years into that journey, the power of time.
Yeah. And you tend to realise that after a decade, because then you're actually seeing real tangible growth, and you realise that, hang on, I can't get that property for that price anymore, provided you bought in the right market, right? And then you're looking at it from, okay, so that's double, but we couldn't foresee that, right? We could see it in theory. But it wasn't tangible, right? Because you don't sort of expect, if you take today as an example, right? So an average house in Sydney would be 800 plus, right? In the outer fringes. And if you look there and you think, okay, I can't see this going past a mill and a half, right? But I look at those same areas 15 years ago, those properties were 400, right? So it's got that, so long as it's got the affordability and the money flowing through that community to give that affordability to sustain that growth in terms of rent and in terms of price, then there will be growth, so long as we address all of the other key factors, like the key one being the employment nodes. How far off are we from the employment nodes, and are there multiple employment nodes around that suburb, around that property?
Yeah, basic fundamentals. And, we quite often talk about the different areas and, even regional properties and, all the different options and, what looks good. And, even Tasmania has had its sort of limelight over the last couple of years. But then, it always comes back to exactly what you're saying. What are the long-term drivers, right? And the long-term drivers comes down to those things that you mentioned, right?
Yep.
What's the supply and demand through population growth, through employment opportunities,
The construction pipeline.
Yeah, the construction pipeline, the availability of properties, and all of that sort of, those fundamentals come into it. And predominantly we've bought in my portfolio, we've bought on the eastern seaboard. Because when you look at where the areas of growth is, and you look at historically the growth in values over time, it's around where those employment hubs are. Right. So looking at your Sydneys, your Melbournes, your Brisbane, because where are your big multinational companies?
Yep. And then they have those knock-on effect of, there'd be other companies supplying these multinational companies, or it's got lots of employees and they'll be buying homes, they'll be buying cars, they'll be spending money in that community. So that creates that vibrancy.
Oh, definitely. And, and again, looking at the fundamentals, and you mentioned a property in those outer suburbs, right? I look at one of my first purchases was that Roos.
I remember that one.
Property. And,
So for those that are listening, Roos is a suburb in Macarthur in New South Wales, about 45 minutes out of Sydney CBD on a good day.
Exactly. But, you look at it and you look at it now and say, we purchased that property back in 2012 and it was 304,000.
Yep.
For a 5-bedroom home. Yes, it needed a total renovation. I remember, quite often talk about, the sweat equity in terms of, and I remember myself and Melissa in the property, and we're ripping up the carpet, we're getting bitten by mites, those and obviously it was our second investment. We didn't have as much money to be able to invest and pay someone to do renovations, so we did the old sweat equity where we would put our own sort of effort in and do a little things, do some of the manual things to keep the cost of the renovation sort of down. And by doing that, immediately we were able to add value to the property. We were able to increase the rent. So if you look at that property, it was virtually positive cash flow or neutral cash flow
based on the interest rates then, right?
Yeah, based on the interest rate back then from day one, right? And you look at what the properties have done over that period of time, and going back, we're on probably 12 years later, and I probably estimate that property to be worth around 900. I don't know what you think it might be worth. If I better in Roos these days, that's your stomping ground.
That's because you own it. It's not worth much. But it'll fetch 900 any day of the week. It'll fly out the door at that price, right?
So you look at that. So you've bought a property that 300,000 12 years ago. That's tripled in value.
Yep.
That for most of the time it's been washing its own face.
Absolutely.
Right?
Yeah.
It's just about to come off fixed actually in July. And
Ouch.
for the first time, it might not wash its own face. So I might have to put some money into it.
Yep.
But it's been an amazing property. But would you have thought that, hey, a Campbelltown property will be worth $1 million?
Yeah, well, no, I honestly, I wouldn't have thought that, right? Because there was no precedent for that, right? So at that time, the ceiling was 500, 550 for a house, and we bought that below that ceiling, obviously, right? So, and then we pushed it up to that ceiling by doing the renovation, right? Now, it doesn't mean that we've added up 200K in equity, but we started its journey towards that ceiling. And as the ceiling kept moving, the prices kept moving, the value kept moving, right? And if we look at it from that particular property, right? Let's say that was the only property that you had bought, that we bought when the green shoots were coming out in that market, right? So it was not fashionable to buy that because everyone was going after the pristine property that had no work. But we got that property because it suited it as a springboard to the next one, because we created the equity and therefore created the exit strategy out of that property, being in the early stages, right? Definitely. And especially with business going through its growth phase as well, and money not so easy to get at that point in time. It really we really made sure that we had all that exit strategy there. And then the rental income in that area. So if you look at it at that point in time, the demographics were definitely shifting in that suburb, right? So if we had just looked at just the data that was available back then, now there's a lot more data available now, but back then, you would have sort of think, okay, it hasn't done any growth for the last, 7 years? And, will it really grow? And a lot of people, when they're investing, they need to see tangible growth before they jump in. And usually it's already too late because you're now paying more. So when one of the comments you made is like, I wish I'd started earlier, right? And the reality of it is that if you're delaying your entry, you are consenting to pay more for that property.
Exactly right. Yeah, and a lot of people, and we see it as a mortgage broker. They have that analysis paralysis. Or quite often, you'll see a first-time buyer that'll, I don't want to pay that fee in mortgage insurance.
Yep.
And they'll save a 20% deposit or continue to save, not understanding the basic fundamentals of the market. Well, the market's growing. If you look at some of the different markets around Australia over the last 12 months, in what should have been a market with 14 interest rate rises that is actually slowing, the market has grown by 10%.
It has.
Right? So if you look at, you mentioned, Western Sydney, $800,000 first home buyer property, that property's now gone up by $80,000 in the last 12 months. And, for the sake of not wanting to spend, $10,000 or $15,000 in mortgage insurance, they're now paying an extra $80,000 that they're going to be paying capitalised interest over.
Which would be far, far more than the mortgage insurance they pay, right?
Exactly, right? And so, we used to have that discussion. And, if I look at my portfolio, I did pay a lot of mortgage insurance. I think the first properties I bought when we could still, buy properties with a 5% deposit. And, I think, and this was a discussion I would have with many clients around, okay, what, coming back to what we were saying before, what is that overall strategy? And so, it may be that I want to get to a $2 million net asset position, or it might be I want to buy 5 properties, right? So, looking at the amount that they have available to invest at that point in time, and let's say, for example, they refinance their properties worth $1 million, they owe 600. We can refinance it up to 80%. We can get them $200,000. At that point in time, we have a decision to make, right? We can potentially buy one property at $500,000 and not pay mortgage insurance, or we can potentially buy 2 properties at, say, 88% plus LMI and buy 2 properties, right? And so, and then we're, instead of holding $500,000 worth of assets, we're holding $1 million worth of assets. So on average growth rates of, say, 7%, that $1 million portfolio is going to grow at $70,000 a year, right? And obviously it's going to be compounding and so forth, opposed to having one property that grows at $35,000 a year, half, right? So yes, I can pay LMI, and on that you may pay $7,000 or $8,000. So in total, you might pay $15,000
between the two.
Between the two, that's tax deductible. But you're controlling 2 assets, right? And so instead of getting $35,000 in growth and not having that fee per year, mind you've got $70,000 worth of growth, right? So in year 1, that additional property and the growth of $35,000 has more than paid for your LMI fee. And you're now in a position where you're closer to your goals, right? Because you've got the right advice moving into that property portfolio. And I think that is a key, it's having the biggest strategy and having the right advice in terms of to be able to achieve those goals.
Yeah, absolutely. And when you look at it, right, so a lot of people, when they're starting out, they try and minimize what they're trying to buy in terms of purchase price, right? And they mistakenly equate that to, it's going to cost me less to hold, right? Now, the cost is in 3 facets, right? One obviously is the psychological impact, right? So if it's costing you an arm and a leg, obviously the wrong property, you haven't done your sums right, and you haven't set your goals correctly. Then it is actually the lower the property price, you're squeezed out in today's market, you're squeezed out further and further out, and potentially in the lower socio-economic areas, right? Nothing wrong with that, and those strategies still work, but that means that it may have more of a opportunity cost because you're doing more repairs. There's less spurty growth in those properties as compared to maybe spending 200k more, your holding cost is relatively the same because your rent is higher on this 700k property as opposed to the 500k property. So you really actually got the relatively the same holding cost when you look at the holistic picture, and you're getting faster growth in those, and you potentially got a better quality property. And then we also look at it from the worst case scenario, right? We need to have that liquidity in the property, liquidity on two formats, right? Liquidity in terms of accessible equity from a lender's point of view, and then the ability to sell that property if things don't go your way, life doesn't go your way, or your appetite changes.
Yeah. I mean, and that was always my philosophy, Vic, in terms of, why buy one property with a negative cash flow? It may be a sexier looking property in a more desirable location, but the return isn't there from a cash flow perspective, right? So why limit yourself to, sort of one property when, for the same amount of out of cash, you can potentially buy a multiple properties. So let's say, for example, and I know, we used to have this conversation, in terms of looking at someone's, how much can you afford on a negative cash flow basis on top of everything you've got there? Let's start there, right? Let's start with that.
Without taking tax into account.
And let's start at that position, and then let's build our strategy from there. Because, let's say, for example, it was $1,000 a month that they had. We've got an option. For that $1,000 a month, we could potentially buy one negatively geared property and you can contribute. Or we could look at the strategy of, as you said, a $700,000 property where maybe it's got a granny flat and a better cash flow on that property, which means, that property's not going to cost you anywhere near $1,000 a month to hold. And potentially for that $1,000 a month, you can have 3 properties working for you and, capital gains, which is the real on 3 properties rather than 1. And, as soon as you sort of understand that point, then as you mentioned, it becomes one of those, key parts along with those other things around, liquidity and so forth. The other thing I'll add into it, which is really, really important, and I've seen that, with 14 interest rate rises, is the people who had buffers and cash flow buffers in place to get through to ensure that they can hold their properties for the long term. I think that's another point that is really important.
And I'm glad you brought up the buffers and interest rate, right? You mentioned earlier interest rates. Your journey in the 15 odd years as a property investor, you would have seen changes in finance, you would have seen changes in interest rate. You just mentioned that one of your loans are getting off fixed rate. Yes, at least someone else is feeling my pain. But how has that journey transitioned over the years, and what were the aha moments, and what were the lessons along the way that we can impart to our listeners?
Yeah, so I think understanding where you're at within your property journey is something looking back. And we used to talk about the different phases, right? In terms of, yes, you're in an accumulation phase, you're in a consolidation phase, and then you're in the retirement phase, right? So there's 3 phases that we used to talk about. And within that accumulation phase, you're really set and really focused on your goal. And, at this point in time, and I think looking back of it, you sort of question yourself and you're saying, is this really going to work out, right? Is this, is this really the strategy that I should be going down, right? And there's the doubts, and we spoke about the Brisbane market prior to coming on air, and I had a number of properties in that market. Every year it felt like they were saying, "This is going to happen. It's going to happen. It's going to happen." And just having faith in it will return to the long-term trends. Over time, and being patient, right? And being patient. And whilst you're in that accumulation phase, you may not see the numbers in terms of your net asset value growing as quickly as what you'd want, especially within those early years. But having the faith that, hey, long term, the numbers will stack up, right?
Yeah.
They will return to their historical growth rates. And, as you said, it's probably around that 10-year mark that you really look at it and you go, hey, there's some substantial sort of gains here, right? You now are in that the position where you can see how it works, because it was probably around around that sort of 2021 where Brisbane went up, and I remember looking at the portfolio, and I hadn't looked at it for about 6 months, and then I did a bit of a review of the values, and I was like, whoa, like it had grown by 60 to 70% in a period of, no joke, of about, we were waiting for so many years. And I think, that's one of the lessons that, historically, property may go up at 7% a year, but it's not linear, right? It's more like a set of stairs.
It's lumpy, isn't it?
Yeah, it's a set of stairs, right? It can be flat and then it can rocket up, right? And I think, in my experience, and I saw a lot of people get frustrated with the Brisbane market. I'm sure you've probably had clients.
I've had clients that have sold out and sold out too early, right?
Exactly.
Because they're not listening to the market experience that we've got over the years of investing, right? I've been investing for almost 30 years now. And I've seen many markets, many interest rates, many tribulations of how everything changes. But the fundamentals never change.
No, the fundamentals don't change. And so if you look at it, all right, and it's more like a step. If you imagine, a graph, and it's not linear, it's more like a step, and, these markets will change. And if we look at a market like, Perth at the moment, it's flat for 10 years sort of plus, but, I think I saw a graph yesterday, the quarterly, it's on track for 17% growth.
Yep.
Right? And if you look at the predictions over time and where the median price of a Perth property is compared to a Sydney property, it's around half, right?
Yeah.
But historically, it hasn't been half, right? It might have been at around 70% of the Sydney price, right? So there's a mismatch in terms of where the overall value of those properties is aligning. Hence why, a number of people over the last few years have, gone to places like Perth and Adelaide and, northern Brisbane, because the affordable markets have been there. So, patience and understanding, what the effect of time is, and, not, you understand. And one of the things that I teach my mortgage brokers is, jump on and do a compounding growth calculator, right? Just, search one and type your portfolio in and look at the different changes. Where is it going to be in 5 years? Where is it going to be in 10 years? Where is it going to be in 20 years?
And don't embellish on the figures. Make it a really low compounding. You'll still see the magic there.
Oh, exactly. So even if you use, inflation or 5%, not the average 7% that has historically been there, but you'll see the effect. And, one of the things that our accountant said to us is, that's always sort of stuck with me, is as soon as you sell a property,
Murphy's Law, right? It goes up in value, right?
Yeah, you're selling all future capital gains.
Yep.
Right?
Absolutely.
So, plug that number in there, and if you sell that property now, then you're selling all that future capital gain on that property.
Yeah.
And that's powerful.
That's right. It is. And as a lesson over here, we really look at, and there's a lot of Facebook ads about, buy 10 properties, buy 15 properties. Everyone seems to be focusing on the number of properties. But what if you bought fewer properties and held them for longer, right? Imagine that, right? So you're still buying within your means. You're not compromising lifestyle. Because I strongly believe that lifestyle needs to happen in the forefront. Investing happens be in the background, right? So it's not impacting lifestyle. Now, of course, if you're having Uber Eats every 2 meals a day, that needs to be cut back, right? but normal lifestyle should not change with investing, and it is a time game, right? And you mentioned in terms of Brisbane, when you came back 6 months later and realized how big the growth was. The old adage of a watched pot never boils does come to mind, right? Because we tend to try, especially in today's day of instant information, instant gratification, we tend to try and find growth immediately. So if we bought today, it needs to be going up in value this year. It might not be the case, right? You brought up Perth, and how for 10 years there was no growth there in Perth, and when you look at the cycles there, from the bottom of the market to the next peak generally is 12 years in Perth. So if we're buying pretty much at the peak of the market, we really need to be buying a roost property there, so that we're forcing the value up. So we're getting ourselves a bit of buffer, so when it goes sideways, we are still in the money to be able to exit out of that property. Very easy to get into a property, much harder to get out.
Yeah, definitely. I've just, found that in terms of selling. I just sold my owner-occupied property, and what I thought was going to happen to what actually happened was, two different things. And it's the same. I don't, historically I haven't sold properties, but in the last 2 years I have sold a couple of properties, and so sometimes it works out.
Yep.
Two that I sold in Brisbane, first open houses, bang, they were sold, right?
Yep.
And, property's pretty good, it's pretty liquid, but some others, didn't, right? So you have to understand that, whilst that exit strategy they mentioned around how liquid is it, and the quality of property that you buy does make a difference in terms of when it comes to realising that should you get to that point where you offload one.
Yeah. We're going to do a bit more of a deeper dive in your portfolio, but if you're enjoying what you're hearing today, can you hit like, subscribe or follow, depending on which platform you're watching this, so that we can share this experience with a whole lot more other property investors out there. That'll certainly help us a lot in terms of how we put this together. There's a lot of people in the background that make this possible, so that will really help us spread the message. So Ross, in terms of your portfolio, you've got exposure then in different states. So which states have you got your properties in?
So I've got exposure in Sydney. So I started in Sydney, and then we went to Brisbane, and then we went to Melbourne, then Adelaide, and then finally, 10 years after I started, we got to Perth.
Yep. Yeah. So it's been a journey. So you've got exposure in all of the key markets, right? And all houses, or they're houses, units, blend?
It's a mixture. And I think that's an important lesson. And, a lot of people say, you've got to buy houses over units. And, I've had a mixture of both, and I've had some really good performances in terms of both. So I don't think there's a set rule that you need to buy houses. Yes, generally, land value will increase a little bit, but it's not to the extent that a lot of people think it is when you look, when you've got the history of time to look back on, that's for sure.
And the key message I'm hearing all along is that you got to give it the time to do its magic, right? There was one property I did want to bring this up, right, which is based. It comes back to my experience and my regrets in terms of property, and that's the one in Campbelltown, the villa in Campbelltown that we bought that was renovated, right? And we're talking about Sturt Street, and that's the I had been pitched that villa 8 years before you bought it, right? And this is inexperience and over analyzing, right? And so when I had walked into that villa, you had put your hand on the wall and you come up with cigarette tar. It was that bad, right? And it was pitched to me 7 years prior to when you bought that. The price on that time was 120K, right? And for the life of me, I could not imagine how I would paint and how I would pull up the carpets and change the carpet. I was overanalyzing on that, even though the agent was telling me back then, well, all you got to do is just let me organize it. I'll get the handyman to do it, right? But I was overthinking, overanalysis, right? Yeah. And here's a clear anecdote of missed opportunity, but also growth in the market, right? So we ended up buying that in your portfolio some 7-8 years later, and we paid, I think it was 300 something from memory.
I think it was cheaper. I think it was about 240.
240, that's right, 240.
Yeah, I think it was about 240 that we paid for it.
Fully renovated.
Yeah, and talk about green shoots. I remember back in the time where that was around that sort of 2012, I think was around the time when we purchased that. But that Sydney was going through a real growth, and it had just sort of started where, and when these markets start, it's hard to
judge value.
To judge value. And in terms of, it was more, we probably didn't get it at something that was under market, but it didn't matter. My mentality was at the time, you just need to get into the market, right? Yep. And I think there's certain times where people will delay. They'll go, they'll say, "Oh,
I want to get it cheaper."
Yeah, you're a buyer's agent. You're meant to get me a deal that's, and you lose sight of what the bigger picture is. So, we're sitting here, 10 years later, and that property has doubled in value. Again, it's looked after itself pretty much from a rental perspective. But it was a perfect example of, knowing and understanding what's going on in the market and just being willing to pull the trigger and do something. Right? Because had I not, taken that opportunity, and there's never going to be the perfect property, right? I think a lot of people say, I'm holding out because there's not going to be the one. And if you look at that Stewart Street property, it's probably not the perfect property, but it was it's property.
Done its job.
And it's done its job, right? So, so I think it's, realising where the market's at and acting.
Yeah. And when I've invested over the many markets, and so there's 3 markets at play, right? So obviously, the finance market, how easy it is to get money and how easy it is to hold on to that money. So interest rates and obviously loan to value ratios and assessment rates. In terms of the growth cycle, both from a rent and value point of view, and then in today's day and age, the media cycle, right? Because media's got a whole lot to answer for in terms of the generational mistakes people are making in terms of putting together a portfolio, right? And when you look at those types of properties, it's understanding what's at play and what type of property you're buying and what the strategy is for that property. And for some, it may not go as high as what you anticipated. And then there'd be other ones where you come back and get really pleasantly surprised to say, hey, I did not expect it to go this far this soon. Obviously, COVID's helped with a lot of markets by creating that catalyst, right? So if the fundamentals are there in any market, it just needs a catalyst to get it to in inverted commas, boil, right? And depending on whether it's a soft boil or full rolling boil is determined by supply, demand, the market sentiment, and how people perceive growth and perceive opportunity in that area, right? And that brings me to Noel Lane, right? In Thompson, the house that we got for you there. Did you want to talk about that?
Yeah, so, this is, I think it was probably a couple of years later, so probably around 2015 from memory, around about that time where we looked at that property. And Noel Lane, for those of you who don't know where it is, it's a suburb of Geelong.
So the Bellarine Peninsula.
And this particular property needed a bit of work. It was on Thompson Road, as you mentioned, and the price back then was $185,000. Right? So virtually
can't buy units at that price anymore.
Exactly. So you're buying it for land value. Yes, it did need a bit of work, but it did have opportunities. Right? People were splitting those blocks. It was on a decent sized block, and I think you could subdivide. You couldn't put a granny flat, but you could subdivide those blocks up to a certain smaller size and put a secondary dwelling, which a number of people sort of were doing with those types of properties. So it did have some opportunities within the properties. Yes, it needed a bit of work to get it to the point where we leased it and to got a good rent. But I think from early on, again, 185 it was rented, and that it wasn't really costing me much to hold given the yield that we were getting at that point in time. From a socio-economic point of view, and
it was not fashionable.
Yeah, it was not fashionable. Corio and Norlane were not back then were not fashionable. But if you look at it in terms of, and we often sort of spoke about this on the Ride and Track meetings and personally, that it's not about the type of property that you would want to live in. It's understanding the fundamentals and understanding the types of tenants. And if you look at my portfolio, I think the average purchase price over is probably only around that sort of 300,000 mark, or maybe a tad under. And the types of properties that, and the tenants that it attracts is that lower socioeconomic and the demands that they require on those properties and so forth. So if you look at, a property like Norlane, it's, yes, I've had a couple of issues. I think, the copper pipe went missing from under the house and a couple of, stories in terms of early on within the property. But overall, it's been a great performer. And, what you were telling me that you're buying properties down there at the moment. And so that $185,000 property, what would that be worth today?
Can't touch them below 450. Yeah, and 450 is a bargain there today.
Yeah.
Right.
So, less than 10 years. And again, even though it's not your blue chip suburb, it's done its job. It's more than doubled. It's looked after itself. So, again, the history of sort of time, and there is potentially still opportunity to do something with that property down the track.
And that's another lesson there, right? So you're not necessarily pulling the trigger to unnecessarily develop because you want to have something to do, right? And when you're looking at portfolios like this, in areas like this, we were early adopters there. And you mentioned it, most of your properties average price is 350 or thereabouts, right? It was still top dollar back then, right? So that 350 today is your 800k properties, right? So if you're waiting and trying to buy a 500k property in that area, you'll be waiting for a little while. So you've got to pay that 800 and wait for it to become your 1.2 as the years go by. And the main thing that you need to look at is not the amount of debt you've got, but the dollar amount per week you need to chip in from your lifestyle money or your investing money to hold on to that debt, right? As soon as you start focusing on the amount of debt you've got, you're just starting to look at it wrong.
Oh, exactly right. And, the old adage of, Robert Kiyosaki, Rich Dad, Poor Dad, what is good debt, what is bad debt, and understanding those numbers. Because I think, when people consider debt, they consider it as, if I have to repay it with my own money, not understanding, how it works and how, it's like a loaded gun, right? So, you can use it for good or you can use it for evil. And in terms of if we look at, debt the same way, it's sort of, debt allows us the leverage to be able to leverage into properties. And yes, it does come with a repayment, and we need to, as I said, there's ways that we can minimise the risks in terms of to make sure that we can afford those repayments. But understanding, the repayments and what it is going to cost you to hold it on a week-to-week basis is by far more important than the big number.
Yeah, absolutely. And Ross, we could continue talking about this forever. And we've had many conversations about the portfolio and property investing, and I'd really like to bring you back again and dwell deeper into the philosophies of investing and your journey. But I'd like to thank you for your time. And while I've got the opportunity, if you're working with a broker, put your broker in touch with Ross. He is a brilliant coach to build up their business, and we'll put the link to his website in the show notes. Ross, thank you very much. Before we go, any parting words of wisdom to our listeners?
Just get started. Have a crack, and you won't regret it. I think get advice from a team. Don't try to do it alone. Get in touch with Victor and his team, and it's something. Even though I was an experienced mortgage broker living and breathing property, you don't have that emotional attachment that you do to your own home, and so there's an opportunity cost in not taking action. And the best way to take action is to do it with a team. So if I looked back at the buyer's agency fees, I looked back at the growth that we've just spoken about in this podcast, it sort of morphs into minuscule in terms of the long-time value that you'll get from it.
Absolutely. Really wise words, Ross. Thank you for your time. And for the listeners, don't forget to like, subscribe, or follow our platform. And if you've got any questions, send it to questions@rightpropertygroup.com.au. We'll see you again in a fortnight.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.